Welcome to the Ultimate Beginner's Guide to Market Structure. In this course, you'll learn all about market structure in a simple and neatly organized way for your convenience. Without further ado, let's begin the course. Market structure is simply the logic of how price action evolves over time. Understanding precisely how market structure works allows you to identify trends and trend transitions more easily. Identify specific trade opportunities that appear in different market scenarios. Identify the correct levels to place stop loss and take profit orders. Remove the mystery of how price action moves. And extract order from the apparent chaos of price action. No matter which strategy or approach you use, the knowledge of market structure will help you immensely. The first thing anyone notices in a price chart is the fact that the market forms highs and lows. Even though price action seems chaotic, we also have a feeling that there is a structure behind it. There are basically three types of behaviors that highs and lows can display, and even though this sounds simple, later you'll see how it can get pretty intricate. The market can move in an uptrend, a downtrend, or in a sideways movement. The best way to identify these three basic market scenarios comes from the Dow theory. An uptrend is identified by higher highs and higher lows. In an uptrend, buyers are generally stronger than sellers, so the sum of upward price movements is larger than the downward price movements. A downtrend is identified by lower highs and lower lows. In a downtrend, sellers are generally stronger than buyers, so the sum of downward price movements is larger than upward price movements. A sideways movement is identified by flat highs and flat lows. In a sideways market, up and down price movements are relatively the same size. Another way of looking at this is that in an uptrend, there is more demand than supply. In a downtrend, there is more supply than demand, and in a sideways movement, supply and demand are in equilibrium, roughly speaking. One important principle related to trends is that a trend will continue until a major force disrupts it. This is the parallel between trends and Newton's first law of motion that states, an object at rest stays at rest, and an object in motion stays in motion unless acted upon by an external force. This is why trading with the trend tends to be easier than trying to catch a major reversal. Trading with the trend is easier than anticipating a reversal, but the reversal will eventually come, so you need to be prepared for that. When we look at the Dow theory and the Wyckoff method, we can define four main ways that price action reverses. The failure swing, also called a pullback, the non-failure swing, also called an expanding pivot or trap, the double top or bottom, and the V pattern, also called a climax. Let's go over the logic behind each one of these four types of reversal patterns. Let's look at an example of failure swing in an uptrend. Like we saw before, an uptrend is characterized by higher highs and higher lows like we can see here. At a certain point, the market will fail to produce a higher high. The logic behind that is simple. Buyers are losing strength, and they fail to produce a higher high, giving space for the sellers to come in. In order to confirm the failure swing, price breaks a previous low, therefore creating a lower low like we can see here. This is an indication that sellers are indeed entering the stage and the market might be turning to the downside. The way to trade a failure swing or pullback is not to sell the breakout, but to wait for price to come back to the supply zone near the failure swing. That will provide a much more precise entry and a logical place to put a stop loss order. If you understood the logic of the failure swing, it becomes much easier to understand the logic of the non-failure swing. Using the example of an uptrend again, the non-failure swing will occur when the market produces a higher high and immediately after a lower low. In the failure swing, first we had the failure of buyers to make a higher high, and then sellers come into play. In the non-failure swing, sellers appear more aggressively. It's a greater statement in some sense. The lower low after the higher high represents a rupture in the trend. It's also easy to see why this pattern is also called expanding pivot. Highs and lows expand over time. The way to trade the expanding pivot is to wait for price to retrace back to the supply zone near the last higher high in the case of an uptrend transitioning to a downtrend. The double top or bottom is something in between the failure swing and the non-failure swing. In this pattern, buyers produce a flat high, meaning a double top. The logic is that while they still have power, they are not powerful enough to create a higher high. The confirmation of this pattern comes when sellers produce a lower low. The ideal scenario is to wait for price to come back to the supply zone near the flat high. Like in the other patterns, the trader should wait for a pullback to the supply zone in the case of an uptrend, transitioning to a downtrend like this. There is another way of trading the double top, which is to anticipate the formation of the double top at the resistance level by watching how price action behaves in that level. Later we'll see one example of that. The fourth pattern is the climax, also called V-top or bottom. The climax happens when the dominant market player, which are the buyers in this case, produces a clean and overextended movement. This movement tends to exhaust the energy of this market player, and what follows is a clean movement from the opposite market player. The way to trade this pattern is to pay close attention to the subtle reversal mechanics of price action after it has been extended. Even though these four patterns are quite simple, sometimes they intertwine and give rise to deceptive situations, and there are several variations of how this can happen. For example, in this illustration, we have a double top being confirmed by a lower low. However, the market disrespects the supply zone from which a short trade could be framed and forms a higher high, therefore creating an expanding pivot or non-failure swing to the upside. Notice how one small change in the evolution of highs and lows turns the idea of a trend reversal into a trend continuation. The trader must be able to adapt in real time to the new scenario, which would be to frame a trade at the demand zone near the low. So far, we have been talking about market structure in terms of highs and lows only, but once we add the candle bodies and shadows, things start to get a little more interesting and intricate. The relationship between highs, lows, candle bodies, and shadows will alter the interpretation of market structure. This gives rise to four concepts: true breakout, solid structure, false breakout, and fake structure. Let's understand the logic of why that happens, observing an uptrend once again. Imagine the following situation. Price makes a higher high, closing above the last high. Technically speaking, that is a true breakout. That also means that the low in between these two highs can be classified as a solid structure. The reason for this is that the buyers that initiated the movement in the low were able to create a higher high, closing above the last high, meaning that they were able to prove themselves in a way. Now imagine a slightly different scenario. Price makes a higher high but without closing above the last high. This is a false breakout, which leads us to classify the low in between as fake structure. The reason is that even though buyers could go above the previous high, sellers were able to absorb them and make price close below the last high, showing that buyers are not as strong as they seem. Notice that in terms of highs and lows, the market might be still going in one direction, but when we look at the bodies and shadows, a trend change might be occurring. A false breakout to the upside can be seen as a bull trap pattern, meaning that buyers are misled to the upside only to find out that the market will drop right after. A false breakout to the downside can be seen as a bear trap pattern, meaning that sellers are misled to the downside only to find out that the market will rise right after. It's common for beginners to think it's a good idea to go long on the breakout of a high once an uptrend is established, or on the breakout of a low once a downtrend is established, but that's a very bad idea for two reasons. Breakout traders are easy prey for market manipulation. They are the ones who get hurt in bull and bear traps. The second reason is that a breakout trade is very imprecise. You don't want to be a breakout trader. You want to be a pullback trader because that will allow you to use smaller stops, more precise entries, and larger targets. It's hard to fight the temptation of getting in the market when a breakout occurs, but a trader must learn to be patient and wait for the pullback. Sometimes the pullback doesn't occur in the way you expect, but that's fine. There is always another trade to be made. In trading, precision is not a vain exercise, it's a necessary one. Imagine that we have the stop loss and target on the same levels, and the only thing that changes is the entry. A more precise entry dramatically increases the risk-reward ratio. This is what technical analysis is all about, enhancing the location and timing of entries in order to minimize risk and maximize reward. It's also important to understand the relationship between market structure and liquidity. We must first define what liquidity really is. Liquidity is the ease with which a market can be traded without causing significant changes in price. Liquidity is directly linked to market depth, which is the number of orders across price levels. The deeper the market, the greater the liquidity. There are certain locations in the price chart where the market tends to be deeper, and therefore liquidity tends to be greater. The most obvious of these places are right above highs and right below lows. These places naturally have clusters of orders because many traders either put their stop-loss orders in there or they attempt to enter the market using the breakout trading mentality we just talked about. For example, right above highs we have the buy-stop orders of breakout traders who think it's a good idea to go long when price breaks the last high. We also have the stop-loss orders of traders who went short near the high, recalling that the stop-loss order of a short trade is a buy-stop order too. Right below lows, we have the sell-stop orders of breakout traders who think it's a good idea to go short when price breaks the last low. We also have the stop-loss orders of traders who went long near the low, recalling that the stop-loss order of a long trade is a sell-stop order. The reason this is important is that by paying close attention to the behavior of price near levels of high liquidity, meaning highs and lows, allows the trader to perceive market manipulation tactics in real time, which in turn allows the trader to avoid being manipulated as well as anticipate what's going to happen with the trend. The bull and bear trap patterns we saw previously take advantage of the greater liquidity right above highs and right below lows in order to manipulate the uninformed market players in a more subtle way. Now it's time to get a little more advanced by talking about fractal market structure. Price is fractal, which means that patterns repeat inside or outside themselves depending on your perspective. This has many serious implications for the way a trader looks at price action. If you are interested in learning the mathematics and implications of fractal geometry in the financial markets more deeply, I have a couple of courses on it. The most basic of these implications is that the time frame you trade doesn't matter. Price action produces the same behaviors on the 1 second time frame or in the monthly time frame. Another interesting thing is that you can see what's happening in adjacent time frames without necessarily switching between time frames. For instance, large highs and lows in the home time frame are smaller highs and lows on a higher time frame. Small highs and lows in the home time frame are large highs and lows on a smaller time frame. When we combine the fractal nature of price action with the market structure insights we have seen so far, we reach very interesting conclusions. The name of my channel relates to how trends happen within trends. The expression fractal flow refers to how a series of highs and lows, which I like to call a flow, happens within itself in ways that provide unique opportunities. For example, in this illustration, you can see a higher high and a higher low, meaning an uptrend. We can go a little deeper and see the market with greater detail. In orange, we can see a smaller flow of highs and lows inside the larger green flow. Notice that in the green retracement in the middle, the green flow is technically going up, but we can find a smaller orange flow going down. The fractal analysis of the market allows us to see a downtrend happening within an uptrend or vice versa. More powerful reversals happen when the two flows align in the same direction. This leads us to a bit of a paradox. Depending on your perspective, price can be going up and down simultaneously. That's only possible to understand once you see how price action is fractal. Even though this seems like a problem, it is a major source of opportunity. Inside a large flow of highs and lows that go up, we can find a small flow of highs and lows going down. Inside the small flow of highs and lows going down, we can find an even smaller flow of highs and lows going up, and so on. This is very useful because the smaller trend helps to create a counterpoint to the larger trend. It's easier to trade when flows are going in the same direction. Once again, if you want to go deeper into this subject, I suggest you check out my course called Fractal Trading, Mastering Price Action and Beyond. In a trend, we have the dominant market player and the subdominant market player. The dominant player in an uptrend are the buyers because they have control. Sellers are the subdominant because they can, at best, produce retracements. In a downtrend, it's the opposite. Sellers are in control, and buyers can, at best, produce retracements. In a sideways movement, there is no clear distinction between dominant and subdominant players because they have roughly the same power. In any market scenario, we can identify at least two flows of highs and lows, one major and one minor. If you pay enough attention to a real price chart, you will see that there are more than two flows, but keeping the analysis to two flows seems to be the optimal solution. Traders are always interested in ways of mapping out market structure, since this helps reduce the mystery and ambiguity of price movement. There are several ways of going about this problem, recalling that these different ways are not mutually exclusive. In fact, there is value to be found in the superposition of different perspectives of how to see the same market scenario. When you open a price chart, the very first decision you need to make is the amount of data you're going to consider. Not enough data will not allow you to see the big picture and gain perspective to contextualize the details. Too much data will not allow you to see the important details and nuances of price action. The optimal amount of data allows you to see both the broader price extremes as well as the nuances of candlesticks. I always suggest to the students of my courses that the first thing they should do when they open a price chart is to count highs and lows. This provides a sense that you know where price is right now in terms of structure, who's in control of the market, and the important levels you should pay attention to. For example, in this chart we can see an optimal amount of price action. By counting highs and lows like so, we can immediately recognize the uptrend and the last demand zone in this case. If price comes back there, we can start thinking about framing a trade depending on how price behaves in that level and how that behavior will be confirmed using auxiliary tools. In this way, you don't need to scroll the chart back and forth and or constantly change timeframes, which only adds confusion in the end. There are a couple of ways of determining market structure automatically, which is especially useful for traders who don't have enough experience with reading structure. The first way is by using an indicator called zigzag, and the second way is by using an indicator called Williams fractals. Let's first see how the zigzag works. Plot the indicator and change the setting called price deviation for reversals to 1, and the setting called pivot lags to 2. You'll notice that the indicator will highlight the larger market structure automatically for you. If you change the price deviation for reversals to 0.5, the indicator will highlight smaller structure, and if you change it to 0.1, it will show even smaller structure. You get the idea. You can also plot two zigzag indicators, one for major structure and another for minor structure, like you can see here. The other way of seeing market structure automatically is by using an indicator called Williams fractals. This indicator will draw an arrow over the candle that represents the highest high or the lowest low among a certain number of candles. In the box called Periods under Settings, you can change the resolution. A lower period like 3 will show greater resolution of structure. A larger period like 9, for example, will filter some of the noise and only show the more important market structure. Even though these ways of mapping out market structure automatically are useful for beginners, nothing beats learning how to do this yourself manually. It's important that you learn how to recognize major and minor highs and lows in the chart and the ambiguity that often emerges when you do that. Once you have highs and lows mapped out in the chart, you need to know how to interpret them. This is where the big three phase analysis methods come in. The big three methods of analyzing market structure are the Dow theory, the Wyckoff method, and the Elliott wave theory. If you're interested in going deeper into each one of these methods, I have one free course for each in my channel. The essence of the Dow theory is to observe the evolution of highs and lows to determine the trend. This is the oldest and still the best way of determining a trend in the market. You can see the Wyckoff method as an evolution of the Dow theory. On top of the simple way of determining trends, we have the perception of well-informed traders manipulating uninformed traders in a gradual process that starts with the absorption of supply or demand depending on which side we're talking about, leading to a final manipulative move that sparks a new trend. The heart of the Wyckoff method is the trap pattern. The essence of the Elliott wave is the recognition of the 5-3 pattern in a fractal manner. If you stick to this basic idea, you're probably going to have a better result rather than following the very specific rules outlined by the theory. You can develop a superior view of market structure by integrating Dow, Wyckoff, and Elliott. When they agree with each other, you can frame a trade with higher chance of success. Another common way of interpreting market structure is by identifying chart patterns, which are also called price action patterns. There are reversal, continuation, and neutral patterns. If you want to go deeper into chart patterns, please watch my free chart patterns course here on YouTube. Even though there are many chart patterns, the best chart patterns are the ones we already saw. If you get used to seeing the market using these 4 combinations, you'll be able to generate good results without memorizing dozens of classic chart patterns, which in reality tend to be unreliable for a variety of reasons. The next way of mapping market structure is with harmonic patterns. I also have a free course about it in the channel if you're interested. You can see harmonic patterns as a type of price action pattern. The difference is that harmonic patterns respect certain vertical ratios, which is why they are called harmonic. Like chart patterns, there are many harmonic patterns. The best ones tend to be the simplest, like the AB equals CD, for example. Another way of mapping out market structure is by knowing what are called M&W patterns, which were outlined by Arthur Merrill. To understand what M&W patterns are all about, it's useful to think about price action on a grid. M&W patterns allow you to recognize the different possibilities that can emerge out of price action, thinking about the alternation of 4 different movements. The 32 patterns can be classified into 6 basic categories: uptrend, downtrend, head and shoulders, inverted head and shoulders, triangles, and broadening formations. Here you can see 4 possibilities for uptrend patterns, 4 possibilities for downtrend patterns, 6 possibilities for head and shoulders, 6 possibilities for inverted head and shoulders, 2 possibilities for triangle formations, and 2 possibilities for broadening formations. 2 important details here are that it doesn't make sense to memorize these patterns and their names, and second is that they don't fully exhaust the possibilities of price action. For instance, the M&W patterns only consider 4 price movements and variations in the y-axis, but price action also incorporates changes in the x-axis of the chart simultaneously, not to mention the fact that these patterns occur within themselves like we saw. The point here is to get a feel of how 4 consecutive movements of price action can appear. It's also useful to see market structure in terms of cycle analysis. We can see the market in a simplistic way where there is a cyclic component and a trend component. If we add these 2 together, we get a series of trending highs and lows. You can see the cyclic component as a flow of highs and lows. In the real market, different flows of highs and lows with different amplitudes and lengths intertwine, and that's what gives rise to the known patterns of market structure. For example, in this illustration, we have 2 cycles. We have a major cycle in red and a minor cycle in green, mimicking more or less what happens in price action. If we superpose these 2 cycles, we get this. Notice how certain patterns we are already familiar with emerge, like the failure swing and the non-failure swing. If we change the cycles a little bit, we get a different situation. In this case, we see that the superposition of these particular cycles ends up forming double tops and double bottoms. If we change the cycles a little bit again, the famous head and shoulders pattern emerges. To make matters a little more realistic, let's superpose a fractal-like function like the Weierstrass function, which already resembles price action quite a lot due to its fractal quality, in a simple sine wave. In this illustration, we can see the result. In green, we have the Weierstrass function with the specific parameters on the left. Notice how it's a deterministic function that generates an apparently chaotic behavior. In blue, we have a simple sine wave. On top, we have the superposition of the 2 in orange. Notice how the orange line resembles the motion of price action with incredible detail. Many of the common patterns we see in the market end up emerging simply because we are superposing cycles. For example, we can see a triangle on the left, a 5-wave Elliott count, and even a small bear trap near wave 2. The point is that the mathematical explanation behind the patterns of market structure we see is the superposition of cycles. If we see flows of highs and lows of different sizes as cycles, it's not difficult to see that buyers and sellers of different magnitudes intertwining in the same playing field is what gives rise to the common patterns of market structure. On top of that, since many of these patterns are well known, they also have a self-fulfilling prophecy effect, which can be good or bad depending on the context in which they are traded. When we observe the flow of highs and lows, we can usually see that it forms an angle. In this sense, the market can remain in a straight line, it can accelerate, or it can decelerate. The interpretation will change depending on other factors. For example, an accelerated price movement tends to be unsustainable, so it often leads to a reversal. The key point here is to pay attention to the angle of price movement, which is an important factor, and contextualize it with all these other elements we saw previously. It's also important to pay attention to the depth of retracements. Generally speaking, there is an inverse relationship between retracement depth and trend power. The shallower the retracement, the more power there is behind the trend. The logic behind that is that when the retracements are shallow, the discrepancy of power between dominant and subdominant players is too great, meaning that the dominant player has too much power and the subdominant player has almost none, so trends will naturally be more powerful. Even though market structure is very important, technical analysis also deals with the forces behind the structure, namely momentum and volume, which cannot be accessed simply by looking at price action. The study of these forces is important because sometimes a price movement looks like it's powerful, but it doesn't have enough momentum to support it. The study of volume and its relation to momentum and price action is also critical. The classic volume tools like the volume histogram tend to be problematic because they are too opaque in a way. The more advanced study of volume lies in order flow analysis, which is especially useful to validate support and resistance levels, as well as supply and demand zones. I have free courses about classic volume tools, as well as a free course about supply and demand zones and order flow in the channel if you want to get into it. Let's look at simple examples of trade setups using market structure. We already established that it's much better to be a pullback trader rather than a breakout trader, so we need to investigate the different ways of catching a pullback. The tricky part about this is that there are multiple ways a pullback can happen. If you're interested in learning more about that, I have a video explaining 20 different ways of catching a pullback. In this first example, we'll study a pullback after a non-failure swing. Here we have the 1-hour chart of the S&P futures. In this next slide, you can see that I highlighted the non-failure swing in black, a lower low followed by a higher high. Once this pattern is identified, you need ways to anticipate the pullback that will allow you to trade with a smaller stop and larger potential reward. One example here is the use of an Andrews pitchfork tool plotted on the high, the lower low, and the higher high. The center line of the pitchfork catches the pullback after the non-failure swing in this case. Notice how the lower low of the candle that touches the center line is very important. That is the type of indication you need to look for in order to frame a trade. Another example here is simply using a Fibonacci retracement tool on the larger leg of the non-failure swing. Here we can see that price retraces and reacts to the very common 61.8% retracement. One interesting detail is that if we look at fractal market structure, we can see a non-failure swing happening within itself. We have a larger non-failure swing in black, and inside of it, there's a smaller non-failure swing in red. Notice how the pullback after the larger non-failure swing stops at the level where the last low of the small non-failure swing got broken. Another example of catching the pullback after the larger non-failure swing is a simple channel. By connecting these two highs, we create an angle that can be duplicated to the low in between. And we can see that the lower line of the channel catches the pullback accurately. In any case, we can see that there are multiple ways of catching the pullback, and we can also see that this trade idea was successful. Ideally, the correct stop loss is just below the lowest low of the larger non-failure swing in this case. We move on now to another example, now in the 10-minute time frame of the Euro USD. In this image, we can see the formation of a double top like so. One of the best ways of trading a double top is to anticipate the second top by watching how price action behaves at that point, and perhaps use some auxiliary tools to help in the confirmation of price action. In this case, we notice that once price reaches the resistance outlined by the first top, it produces a reaction. Some people will call this an inverted hammer, some people call this a pin bar, and if you are a student of my previous courses, you know that this is a fractal bar for reasons we don't have time to go into right now. Sometimes, all you need is a clear reaction to a clear line like this to frame a trade, and it can indeed be that simple. If you need more indications to confirm a trade like this, we can certainly find it. By plotting a modified shift pitchfork on the most important extremes, and then duplicating it to the upside, we see how the double top occurs at a market edge according to the pitchfork. Another quick example here is the plotting of an anchored VWAP on the first top. The candle that forms a prominent upper shadow, and consequently, the second top touches the 2 sigma line of the anchored VWAP almost to the tick. Notice how this is indeed a downtrend, which of course helps outline the overall context for a trade like this. In this third and final example, we have a 4-hour chart of crude oil futures. In this case, I want to show you the V-bottom pattern, which is also called a climax. The V-bottom is usually characterized by an accelerated movement to the downside with several bearish candles in a row, and then a sudden rupture of that pattern, which can occur in various ways. In this particular example, we see a series of bearish candles, and then this pattern is broken by a large bullish candle out of nowhere. This is the indication that the V has reached its exhaustion point. The greater the number of consecutive candles in one direction, and the clearer the rupture of that pattern, the more reliable the V pattern or the climax tends to be. In this case, we can see that the trade idea would have worked. Keep in mind that there are many ways this reversal can occur. Sometimes it involves outside candles, sometimes inside candles, sometimes a smooth transition between candles, and sometimes it involves deceptive price action like small trap patterns, for example, which will stop you out even if you are correct about the direction of the market in some cases. That's it for this course. Obviously, market structure goes much further than this, but this is a good primer in the subject if you are a beginner. Hopefully, you were able to find value in this video. If you want to understand advanced price action concepts and strategies, please check out my premium courses and ebooks in the video description. You can also find a lot of information about them in my website fractalflowpro.com, or you can send me an email directly at support@fractalflowpro.com. If you enjoyed this video and wish to support the channel, please click the like button, subscribe to the channel, activate the notifications, leave your feedback below in the comment section, and share this video with your trading community. Thank you very much for watching, and I hope to see you in the next videos. Take care.